listening to the Project Ignite podcast,
where real digital entrepreneurs reveal their very best tips, tools, and strategies to help you ignite and grow your online business.
ProjectIgnite.com. Your digital business starts here.
Now, here's your host, Derek Gale.
Welcome to another episode of the Project Ignite podcast, a podcast designed to skip all the hype, the BS, the fluff, and just give you guys real entrepreneurs, real experts who are going to share actionable tips, strategies to help you be more successful online. This is your host, Derek Gale, and today we're going to be diving into a topic that I'm actually interested in, and it's a topic that I don't think enough entrepreneurs, especially when you're just starting out, are even thinking about. And it's a little out of the ordinary for this podcast, out of the mainstream sort of digital marketing stuff we do talk about normally, but it's super, super important. And what I'm going to talk about today is about valuing businesses and exiting businesses, buying businesses. And I get questions all the time from entrepreneurs of all stages that they say, I want to sell my business, but I have no idea what it's worth, or they want to buy a business and again, they have no idea what they should pay for it, what's a fair price, or even just being in the early stages of starting a business and realizing that no business is forever. And eventually, you're going to want to exit that business. And so, how should you be thinking about that in the early stages to maybe prepare and plan for that up front? So, although it's not our typical digital marketing flavor, this is very, very relevant. And today's guest is someone that is an absolute expert in this space and has valued over 2,000 businesses and assets, including real estate, industrial, government infrastructure, public companies, private companies, and some pretty cool assets that you may have heard of, like, the Golden Gate Bridge. I don't even know how you value that. Atlanta's airport, Uber, Airbnb, Yahoo, Brooklyn Bridge, Mirage Casino. And as of today, he signed off on over 4,500 valuations with $2.6 trillion in assets globally. So I'm really interested to talk to this gentleman. And without further ado, I'd like to welcome Bharat Kanodia to the show. Bharat, thank you so much for being here today.
Hey, Derek, thank you for having me. Well done. I love the energy.
Excellent. Okay, so I always like to start with my guest's story. Like, how did you get to be this guy doing this many valuations and for such, big names and stuff as well, right? Like, what was your path to get here?
Oh, Derek, I was a young child, grown up in India. I would, look at the stars and dream about coming to America and becoming an appraiser.
Okay, that's probably not it.
Wait, you didn't buy that?
Maybe not so much.
Just like everybody else, right? You stumble into the best things in life, right? The best things in life happen to you by accident. And that's exactly what was it. It was a job that I got out of college, and turns out that my boss liked me and I was half good at it. So I stuck with it.
And so, yeah, because if I remember correctly, reading your bio, you were trained as an engineer, were you not?
I did go to school for engineering, but I hated engineering and I didn't want anything to do with it after graduation. So I was looking for a job in finance. Yeah. But who's going to give a kid who's got an engineering background, who's 21 years old, no experience, a job in finance? Well, I found one sucker, and he became my boss. So I took it from there.
Wow. Okay. And so actually, I mean, to be a business valuator, is there a certification, a designation?
There's no college degree.
Yeah.
for becoming a valuation expert. Dr. Damodran out of NYU Stern has a certificate program, but that is only for business valuations or only for financial assets. I have been fortunate or unfortunate, if you will, to have been able to do all kinds of assets in the world, including some of the most unique or weird assets that you can think of.
Yeah.
I started out doing, industrial plant and equipment and machinery. They liked my work. They moved me up to doing real estate. I did commercial real estate work, hotels and casinos. They liked my work there. Then I moved up and I started to do financial assets like businesses. They liked my work there. And then they put me on the real dark side where I do venture capital and private equity work. I mean, now I'm really just making shit up all day.
So yeah, private equity and venture work. I mean, what are you valuing for those guys? Is that them hiring you to go in and value something they're interested in purchasing, or something that they want to sell?
Great question. So I do it from multi vantage points. So I do it when a venture capital firm is looking to invest in a portfolio company. So I either help the venture capital firm or the portfolio company and advise them on what that investment might be worth. Or they have already put money into the company and they want to know that, okay, it's been 2 years. What is the company worth now? Or they're looking to sell the company to a public buyer or a strategic acquirer or a PE firm, and they want to know what it's worth. Or sometimes I'm brought in on the tail end where somebody paid $100 million, say, for a company, and they need to identify what the underlying assets are. So out of the 100 million, how much is patents, how much are intangibles, how much is workforce, how much is real estate. So I help with all these kinds of different valuations.
Okay, so let's dig into this, and I think this is a perfect segue, since again a lot of our listeners have never sold it. I was going to say the majority of the people here have never bought or sold a business, but they're in a business, right? So they don't necessarily understand the process of this. And now you just started throwing out all these things that you look at to value a business. So maybe let's start there. What is it that what are the things that create value in a business? And I don't know if there's any kind of ranking that you can give us here, but what are the primary things that you look at that create value that somebody else is going to pay you an obscene amount of money for?
Yeah. So there are three real reasons why anybody buys anything, right? Especially a business. And if somebody were to tell you otherwise, call bullshit on it. And the three things are growth. They're anticipating significant growth in the future. For example, Tesla right now, or Bitcoin, right? They're anticipating exponential growth, more growth than's already happened. And that's why it's crazily priced. The other is profitability. How profitable is the business, or how soon it can get to profitability in terms of venture companies, or how fast they can grow their profitability. So companies like Costco or Salesforce, these companies are gauged on profitability, more established companies, if you will. And the third reason is size or risk, where people want to de-risk their portfolio or their investments, and they invest in companies that are larger in size or are relatively low risk. For example, bonds or real estate investment trust, REITs as they call them. Or if you really want the low risk asset, just put your money in Berkshire Hathaway.
Right. So, okay. So now the de-risk category is in terms of why people buy. People that are buying to de-risk, those are obviously probably the big investors, the hedge funds, the big pools of money, right? Most smaller businesses are being bought or sold. I'm going to assume more for growth or profitability.
Generally, yes.
Yeah. Okay. And so, God, do you really think Tesla's? Worth what it's valued at right now?
So this is how I explain Tesla to people. Tesla is currently trading at 1,400 price to earnings ratio. Right?
Yeah, totally.
So that sounds really cool when you say 1,400 price to earnings ratio, right? But let's put that into perspective. What does that mean, right? What is price to earnings ratio? The price of the stock divided by the earnings of the company. That's it. So market cap of the company divided by their earnings of that financial year. Simple. So in other terms, if they're trading at a 1,400 price to earnings ratio, what does that mean? That means for every $1 Tesla is adding to its bottom line, investors are willing to pay $1,400 for that $1. So would you pay $14,000 for a business that gives you a net profit of $10 a year? If yes, buy Tesla. If no, don't buy Tesla.
Point well made. But I mean, this is a whole other rabbit hole to go down. But I mean, the tech market as a whole has been chasing this unreasonable price to earning ratios for quite some time. I mean, Tesla, I think, is an extreme example of that. But I feel like it's not just limited to Tesla. And I mean, they're pricing in the future growth for the foreseeable future. I mean, is there anything other than emotion that you see driving these?
Well, first of all, I chuckle every time a fancy analyst from Charles Schwab or Vanguard or someplace is trying to chastise Elon Musk or Tesla. And I'm no fan of Elon Musk. I'm just talking from a objective perspective.
Sure.
When they say that, that company didn't grow as much as we had anticipated, or, they need to show faster growth. I'm like, okay, Tesla is a car company, or it's a solar company, or whatever you want to call it. It is not a software company. Right? So it is very different when you're trying to scale a software company versus when you're trying to scale a company that's manufacturing cars. To manufacture cars, you need to buy land. You need to set up a building. You need to acquire a workforce. You need to set up machinery and equipment. You do need to put in the right supply chain. It's not like you buy a bunch of server farms and routers and you ready to go. No, cement takes 24 hours to cure. There's nothing Elon Musk or an analyst can do about that.
Yeah.
So if your expectations of earnings are not being met, well, maybe your expectations are improper.
Yeah, that's fair. That is fair. I mean, and if you take, I'm not necessarily a big fan of Elon as well. I mean, I respect the guy for what he's done, but if you take the crazy valuations aside, frankly, what he has done as far as scaling up an automotive company as fast as he has been damn impressive. But to your point, if people are expecting multiples or the ability to scale as fast as software, it's just never going to happen. You're right. It's absolutely impossible.
No, it's apples and oranges. Very different.
Yeah. Okay. All right. So back to our original question before we went off on that tangent there. Okay. So when we talked about, so the initial question was, what do you look for? And you said, okay, growth, profitability, de-risk. Those are one of the three reasons people are buying a company, right? So let's say somebody has built a company and I'm going to, in the space that we play in, and a lot of our listeners, I think it's going to be very heavily focused towards growth. I see it in e-comm. People are building up brands. They're building up e-comm brands, and bigger companies swoop in to buy them because it's a growth. But nobody's buying them for their profitability.
In your business, it's all about growth. Yes.
Yeah. So it's all about growth. So when you're looking at a growth company, what are the value drivers there? What should people be focusing on to create the most value?
What I look for in a company that has zero profitability currently, they're probably burning money. I am looking at their monthly recurring revenue. If they have revenue. If they do not have revenue, that doesn't mean there's no value. There still might be value. I will still be looking at monthly users or growth of those users or growth of the customers or involvement of the customers. Again, you're just looking at metrics which could be financial or non-financial. So if I'm looking at a SaaS company, I'm looking at a monthly recurring revenue or annual recurring revenue, right? But what if it's a company that doesn't really have any revenue currently or minimal revenue? There again, you're looking at customer data, user acquisition data, or usage of the software or what have you. Again, I'm trying to pinpoint that where is this company going? And if I see some kind of a trajectory or an earlier graph, it'll help me estimate the future. If I have nothing right now, well, how do I estimate here?
Gotcha.
Because if you see any of the financials from any of these entrepreneurs, I mean, they're all hockey stick, right? Right now there's this much, but they're expecting this much. And I've seen too many hockey stick projections to hang my hat on them.
Yeah, of course. Okay, so let's take a very recent example. Is Twitter putting together a $4 billion offer for Clubhouse? I mean, Clubhouse, as far as I know, probably doesn't have any revenue. So what would be how would they justify a $4 billion valuation for Clubhouse?
How did Facebook justify a $19 billion valuation for WhatsApp?
I don't know. That's my question for you.
How did Facebook justify a $1 billion valuation for Instagram?
And that's what I'm wondering. Like, what are they looking at? What is the formula that they're running to determine that?
In those cases, it's not revenue. Revenue is not the correct benchmark. They are looking at customer acquisition, and they're really looking at, it's the Wild West, right?
Yeah.
Clubhouse is the Wild West. When they took over WhatsApp, everybody was like, oh my God, they paid $19 billion for what? For 26 engineers and zero revenue? But they had what? 2 billion subscribers? So they really paid for that. And they saw the synergy on how WhatsApp will integrate with Facebook. Yeah, in the beginning they said, no, it's all proprietary. We're not going to integrate it. But, that's what you say in the beginning, right? I mean, the rules change. Why did Brian Acton quit Facebook's board? Because they changed the privacy rules. And yeah, all companies will do that. They'll sell you. They'll tell you all kinds of things to have the PR around the acquisition come out really strong. And so basically, coming back to the point, they're paying $4 billion, not for the revenue. They're paying $4 billion for anticipated growth. Maybe not even the growth that they currently have, for the anticipated growth in the user base and the usage and the subscribers of Clubhouse.
Right. So I'm trying to, for our listeners here, trying to get them to think in the right terms and metrics and KPIs that they need to look at to make those decisions when you're buying something for growth, right? So I'm going to assume that Twitter knows how much a new user is worth to them based on their ad spend or their advertising revenue, and they plug that formula in and they come up with some kind of future growth.
Plus, let's not forget, when Facebook purchased, I don't know the details of that transaction, nor I know the details of the Clubhouse transaction, so I am speculating here. But generally, in such transactions where the target doesn't really have too much cash flow, there you're really paying using shares. Right. So Twitter is probably paying Clubhouse or Clubhouse's investors in Twitter shares. Yeah. Well, that's not much off Twitter's back, is it? I mean, yeah, they're getting a little diluted, but that's really increasing the valuation because now it's all up in the media that, they're just purchasing Clubhouse. And let's face it, retail investors, they don't know anything. And that's why market exists. If retail investors really knew what they were doing, well, we wouldn't be having all kinds of problems that we're having today.
And those problems being things like GameStop?
I was just going to say that. It was in the tip of my tongue.
Yeah, it's true. I mean, it is really true. I mean, when you watch the average retail investor, it's all based on emotion and what they're seeing on Reddit these days, which is actually pretty scary. All right, okay. So, in terms of valuation, if I'm going to buy a business, I need to figure out what value it brings to my business. And the different ways I can do that are what? What are the most common ways?
So you got to think about that. Okay, if buying a business is really no different than trying to get married. Right. I mean, you are trying to hire somebody for your team. You want somebody who's going to complement you. And that's where the synergy or the strategic buyer comes in, right? You can either help them grow, or they can help you grow your top line or their top line. You can bundle your products, or you can always save costs as synergies, right? There's always some synergies in terms of operations, in terms of finance and HR and other marketing. But apart from that, I mean, can you integrate your supply chain? Can you get a bigger bulk buyer's discount from your suppliers? You're looking for all these things. At the same time, sometimes, are you just getting a great deal? I mean, sometimes you just can't pass up on the deal, right? For example, Twitter stock, I mean, it's so high right now that it doesn't matter. I mean, they just made this money out of thin air. So it doesn't matter if there's $4 billion for GameStop. I mean, that's chump change. Right.
Yep.
So it really depends on the transaction or the vantage point of the acquirer.
Gotcha. Now, I just want to go back to one thing you said there that will get you to clarify for the listeners. You said a strategic buyer. Okay. So as far as I know, there's two types of buyers. I may be missing one, but two types. Strategic is one of them. Do you want to explain that and explain the other option?
Yeah, a strategic buyer is somebody who is looking to buy a company to expand their overall market footprint. They're already in the market, and they're either looking to expand their product offering or bring in more customers to that offering by making the acquisition, or they're looking to backward integrate, as in buying their suppliers, or they're looking to integrate forward, buying their distribution network. A buyer that really has a business reason to do this. The other kind of buyer is a financial buyer, usually, which is like a hedge fund or a private equity firm or something. And
now, I mean, when I sold the last business, I sold it to a financial buyer, which was a private equity group, and that was a whole experience in and of itself. And they were obviously a financial buyer. Now, at that point, we were north of 25 million, and so we were a little bit bigger. What is the smallest that you see financial buyers go after?
Depends on the buyer, right? They all have different thresholds, but in general, financial buyers will only touch a company with 5 million in EBITDA.
Yes. Okay. And so, pros and cons of financial versus strategic buyer.
Well, strategic buyer is buying for a business reason. So they will look at your business holistically and help you grow, help you, develop more products, integrate your products into theirs, help you develop really. Whereas a financial buyer is going to be really looking at the nuts and bolts of your finances and going, okay, well, you can save money here, you can save money there. And I'm not saying it's a bad thing, right? Saving money, penny saved, penny earned. So what they're trying to do is they're trying to make your operations most efficient, so they can, I guess, get the most bang for the buck, or just suck the blood out of it.
There it is. That's the right.
Guy.
Suck the blood out of it.
And sell it to the next guy.
Yeah, I mean, look, I've been down that road. And it's funny when I packaged that up and I was selling it to private equity, I had other people in the space say, "Oh, hey, get out, don't stick around. Private equity guys aren't fun to work for." And I said, "Oh no, they seem, I was young. I they seem like great guys. They're going to bring a lot of value to the table." God, was I wrong. I mean, my personal experience and advice would be, if you ever sell to a financial buyer as the owner or CEO, sticking around isn't always the best plan.
Well, you got to stick around for a year or two.
Well, you do, but don't think you're going to ride off happily into the sunset, because all of a sudden you go from having total control to having, in many cases, I would laugh after I'd have a board meeting. They'd all come in, and we'd sit around the boardroom table, and I'd say, "Okay, guys, here's the direction I think we need to go with this, et cetera, et cetera." And then the next guy would say, "Well, this is where I think we need to go with this." And the next guy would say, "No, I think this is where we need to go." And the third guy would say, "No, this is where I need to go. This is where we need to go." And then they go, "Well, I'm glad we all agree on this, Derek. Make it happen." And I'm like, nobody agreed on a damn thing. And frankly, they didn't even understand the business they bought. So, that was that I learned a lesson there. So, interesting times. Okay, so all right, so now let's talk about how to value it. Right, we talked about some of the things that you look at to value it, but this is probably the number one question that I hear is, how much is my business worth, or how much should I pay for it? Now, when I sold to a financial buyer, it was a pretty cut and dry. This type of business is getting 5 times EBITDA, right? And that was it. And then they peel back the layers and try and find, anything they can to, knock the price down during the due diligence process.
That's their strategy, right? They set the bar here, and you are never going north of that. You will only just go south of that.
Totally. Again, a lesson I learned, right? Like they start here, and you're like, yeah, and then they get into due diligence, and they just knuckle and knuckle and knuckle. And the other thing that I learned is, you've got this deal, and then if you back out of that deal, now you're a little bit tainted in the financial world, and people are like, well, why'd the deal fall apart, right? So they all
talk to each other.
Oh yeah, it's a nasty industry. I think more especially young entrepreneurs going into this need to be aware of what they're getting into. Damn it, where was okay? But valuing, right? Like I see it all the time. If I go to flippa.com, which is I don't know if you've ever been there, but it's a website where people list businesses and websites for sale, right? I can go there right now and I will see a whole bunch of different e-comm sites, existing sites, that have been around for a year or 2 years, and they will have multiples of their profit. Can be anywhere. Some people are like 1 times, other ones are like 5 times. It's all over the place. It's absolutely the Wild West. Where do you go with that?
The simplest way of looking at a business is, okay, now I'm talking about businesses that are profitable, right? They have real money coming in, and they're making real money. They have decent operations. Right now, if you're looking at only revenue-based valuations, well, that's a whole different category, right? And those are treated differently.
So when you say revenue-based valuations versus,
as in they don't have positive cash flow.
Okay, so they've got revenue, but they're burning cash, right? Okay, yeah.
Correct. Those fall into a different category, and hopefully those businesses have growth because they're really valued on growth.
Okay.
Businesses that have real cash flow, those are valued on profitability of EBITDA, what have you. So the simplest way to look at a business is go to a simple mortgage calculator. Right? Mm-hmm. And assume you're going to have to put 25 or 30% down to buy the business. Put in 30% down, maybe in some cases 40% down. And then back into the number. So for example, when you go to your realtor and you say, I want to buy a house. The first question they ask you is, okay, how much mortgage payment can you afford? And once they know how much mortgage payment they can afford, they put that in a mortgage calculator and back into the value of the house. And they say, okay, you can buy a house up to $800,000 or $1 million with this mortgage payment. No different for a business, except the assumptions are a little different. So the assumption are, instead of 10% or 20% down, you assume 30 or 40% down, right? Instead of a 30-year mortgage, you assume a 10-year mortgage, right? Instead of a 2 or a 3% or 3.5% craziness interest rate, you assume a 5, 7, 6% interest rate, right? And then you back into the number. That's one way of doing it. Now, again, this is for a simple transaction that you're getting all cash deal upfront. And, you know, the terms of the deal, let's not get into that for now, because that's going to cause a whole different set of issues. So, you know, because you almost never get cash upfront, right? Yeah. If you are, then you gotta, maybe you're just giving it away for too cheap. You gotta look at that too. So that's one way of doing it. The other way of doing it is, you know, you're just looking at comps that, okay, what are similar businesses going for? So there are really only three ways of valuing a business. I mean, you know, again, it's not really rocket science. People just make it complicated. One way of looking at a business is income approach, where you're looking at the cash flow, the profit the business is going to give you for next 3, 5, 7 years, and you're present valuing that cash flow to today, right? For present valuing it, you know, you can look at a different discount rate, but, you know, depending on, you know, what you're really looking for or how fast you're looking to grow the business. Number two is you're looking to find an identical business that, okay, this is the business I want to buy, and this is the closest business I can find like it. Kind of like how they value a house, right? Oh, this house is closest to you. This is the biggest, same size. It has a pool like you do, and it went for, you know, $2 million. So your house is probably worth around $2 million too. Well, the third way of looking at it is, okay, if I were to start this business and spend all the money in marketing and development and hiring staff and technology and putting all my blood, sweat, and tears, what would that business be worth today?
Right.
So this is the way generally you would value a business. Now, how VCs look at a business or venture capitalists, that's very different. They are looking at a business for growth. They don't really care for profitability. In fact, their theory is that if the business is profitable, you're not growing fast enough. Spend the money. I want you to spend the money. Right? They don't want to be sitting on cash. They're like, I got enough cash. Spend the money. VCs invest in businesses that, first of all, have a proof of concept. And when I say proof of concept, that means traction. They would rarely invest in a business unless they love the founder or they love the idea, or, you know, everybody wants it. And it's kind of like dating the prom queen, right? Oh, everybody wants her, so of course you want her. They always invest in businesses that have a proof of concept, as in the business has revenue. The customers, potential customers, have shown that they will write checks to buy this service or this product. Now, then the only thing left is how can they scale the team and they can scale the business, and how much money they can throw in marketing. And in marketing, about 40 cents on every dollar that is invested in venture capital is either going to Google or Facebook or Amazon. Yeah. 40 cents of every $1. So they are just double downing on the marketing because they're going, okay, customers want this. So now let's just identify the perfect customer and do laser focus and just spend 40 cents on that customer out of $1. And rest of the 60 cents, we're going to invest in scaling the business, hiring the right team, giving them salaries, investing in routers or infrastructure, whatever you need to buy.
Okay, so I want to go back to the actual the financing side as well, because I think this is an unknown for, you know, a lot of entrepreneurs. Is okay, I want to buy a business, and okay, I'll put the 30 or 40% down. Who's going to lend me the rest? Because if you walk into your traditional bank, that's tough.
I mean, there are many lenders out there. There are, I mean, in fact, this is actually one of the secrets that most people, when they work for a large company, they're almost scared to go to a private lender because they think of all of them as loan sharks. Well, they're not all loan sharks. They're not all Tony Soprano. Or most of them think of small business owners as, like, okay, like you better call Saul types, right? Look, they're not all trying to launder money. They do, but they're not all at the same level. So, get off your high horse that, this guy is trying to screw me over, because many people who are working for large companies, they only interact with people who work for large companies. Well, their culture, their business culture is very different versus when you start to run a small business or trying to take over a company. If you're trying to take over a nail salon, or if you're trying to take over a small e-commerce business, well, it's highly likely you're not going to be dealing with people from PwC or Deloitte. Mm-hmm. You're going to be dealing with local CPAs and local financiers. And it's not that they're all bad people or they're all loan sharks, but they do want their cut. Mm-hmm. So they're not going to come and bust your kneecaps, but they might charge you 25 basis points higher than the bank. Mm-hmm. Or 50 basis points higher than the bank, but you will get a loan. Mm-hmm. I know many private financiers. I know hard asset lenders. So yeah, I mean, anytime if any of your viewers want to know a good financier, I'm happy to help, because there's so many good people out there, and there's a lot of private money who lend money to new business owners.
Yeah, that's interesting. And I think that's such an unknown world for so many entrepreneurs. We start businesses, we build this up, and I mean, we've all been raised to, you have traditional banks and then you have the other guys. And unless and there is obviously a perception of what the other guys are, loan sharks and stuff like that. And I think a lot of people forego great opportunities because they're afraid to go down that road. Now, when you're buying a business, let's say you're buying an e-comm business, right? And an e-comm business, it has some inventory, right? But most people are running pretty short swings on their inventory, so they don't hold a lot of inventory. They have a website.
It shouldn't be.
Yeah, they have a website. They have traffic to that website, but they don't have any big valuable assets that lenders can repossess. So in that case, what are these lenders using as collateral? Or are they?
The only collateral these lenders have is they're going to be looking at your recurring revenue. Mm-hmm. How much recurring revenue do you get on a monthly basis? Do you have a business model? Valuation is all about business model, Derek. The rest is, I mean, it really is simple. It's just, people like me that throw out fancy terms to get you all confused and, turned upside down like a cockroach.
That's how you make the big bucks.
That's how you make the big bucks, right? And I can go geek, and I can do geek talk like anybody, but I have learned that doesn't help people.
Yeah.
So that's why I break it down into simple terms. What lenders are really looking for is your business model set up in a way that you have the same customers paying you money month over month over month over month, because that's their collateral, mm-hmm. right? That's what they're looking for. So if you got to go out and hunt for a new customer every day and all you got is an e-commerce website and no inventory, you're not going to get a loan. Simple. That's
Gotcha.
Just the way it is.
Right. So they want to see some almost guaranteed revenue, right? And I mean, to that point, I guess for the listeners as well, this is why the most valuable companies in the world now are software companies that are all based on recurring rev. And the beauty of software is it's sticky. The harder it is for people to leave that recurring revenue, the better. And I think that's where people need to understand, like, Salesforce is a beautiful business model, because as long as you're in business, once you start, I mean, I've got one of my companies integrated into NetSuite. I ain't ever leaving. I mean, this year they were like, yeah, the price is going up, and they jacked my price like $20,000 for the year. I'm like, that sucks. They're like, yep. I'm like, okay, here's my check. Like, what do you do? Nothing.
Yeah, they got you by the balls.
Totally.
You ain't going nowhere.
Totally.
And what they're really counting on is migration and user adaptability. If you got a team and they're all used to using Zoom, it's an act of God to make them use Microsoft Teams. And that's just a software that doesn't have data. Now you have a company like Salesforce, which has all your data, and all your people are trained in using Salesforce. You ain't never.
No, you're never leaving. Once you and then you've built your other integrations into that. The more you and this is the kicker with recurring rev software that the harder it is for people to initially set up, the harder it is to retain people when they first sign up. But the bigger the integration is, the better your retention is. It's this fine line, this catch-22. But I think the message to everybody listening here is think in terms of recurring revenue.
There are two videos that I have, Derek. Sorry, didn't mean to.
No,
cut you off.
go.
There are two videos I have created recently. One is called How to Double Your Valuation, and one is called What's a SaaS Company Worth? If you watch those two videos, you'll know exactly what you and I are talking about. SaaS is the new real estate. In fact, it's better than real estate. SaaS is the love child between technology and real estate, because real estate gives you recurring revenue. That's why banks and everybody loves it. But you can't grow real estate very fast, can you? But a SaaS company, you can scale at 500% a year. So SaaS has both. It has recurring revenue and it has growth. It's a beautiful business model.
Oh, and frankly, I'd rather sell my house and move than try and get out of NetSuite. Right?
Yes, it's cheaper.
It's cheaper. It's easier.
Moving from your house is going to cost you what, $5,000, right? But moving from Netflix, it's like, God, you got to train yourself. You got to train your people. That is an act of God.
Yeah, absolutely, absolutely. So, and I mean, look, there are creative ways to add recurring revenue to e-com and stuff, and I think a lot of people a lot of e-com businesses I'm seeing have been going down that road in terms of subscription boxes and monthly stuff like that. But I guess the question I have for you, I see these e-com businesses that are trying to add a subscription component, right? Like I've actually got a subscription to, it's a company called MeUndies. And every month I get a new pair of boxer shorts, and they're the most comfortable boxer shorts in the world. Love them, been subscribed for a long time. So I now assume that they're going to be valued based on that recurring rev. But how would their multiple look? And I don't know if you have an exact, but compared to a software company. Both recurring, but one I can click cancel on and just not get new underwear, and my life doesn't change that much.
It's going to be lower than SaaS because there's less stickiness. But it will still be far greater than anything else. Like The Honest Company, where Jessica Alba is, when my kids were young, we used to get diapers from there. It was a monthly thing. Or the Dollar Shave Club. I mean, it's an e-commerce company, but they had a, recurring revenue model. Less stickiness, right? Unlike Zoom or anything else. But so their revenue will be, their multiple will be less than Salesforce or any other SaaS company, but it'll be far more than any just pure, simple e-commerce company, which has, no recurring revenue.
Okay, and so I just want to highlight for the users a key word that you said in there quite a few times, and just make sure everybody understands that, and that is stickiness. Because, again, if it's really easy to leave, the valuation goes down, right? So stickiness is how hard it is to leave that. NetSuite, Salesforce, SaaS, once you're integrated, they're so dang sticky. But I've got to assume Zoom, for example, wouldn't necessarily get as high a multiple as a Salesforce because it's not as sticky. Would that be fair to say?
Plus, Zoom doesn't have your data. Right, Salesforce has your data.
Yeah,
and for example, DoorDash. Right, back in the day, about a year or two ago, when we used to get DoorDash delivery, they would charge us $3 or $4 per delivery for DoorDash. Like DoorDash would charge their fee, and then we subscribed to something called DoorDash Club or something, and we pay them $10 a month. And they no longer charge us a DoorDash delivery fee. What is that $10 a month? I mean, I probably used to spend $30 a month on DoorDash fees, but they were willing to take a dramatic hit on the revenue just to get that subscription model, because the subscription model can give you a 10x valuation.
Yes.
Right? Totally. Versus the profit that you're getting maybe 1 or 2 or 3x at the most on the valuation. So yeah, they're losing money up front, but they're making it up on the back end.
Sure. Well, I think the best example of an e-com company adding that is Amazon with Amazon Prime. I mean, now they have like how many hundreds of millions of people on recurring rev every single month, and I mean, it's a no-brainer.
Costco, recurring revenue, right?
Yep.
Their membership is recurring revenue. I mean, they don't make money too much on the products. I was watching a documentary and then I started looking at the financials. Their main source of revenue is customers paying their club memberships. Even though it's only $60 or 75, or depending on the one you have, it's not much, but that's the stickiness that makes the customer keep coming back.
Well, I mean, and if you think about it, if you price all your other products low, and you're competitively lower than everybody else, and you leave just enough margin to cover all your costs, but then you have 100 million people paying you $65 a year, well, that's a few bucks of straight up margin. Fascinating. Okay, all right. I mean, I could keep talking about this all day. Like this just absolutely fascinates me. I think it's something that, again, entrepreneurs need to be more aware of what's actually out there and their ability to scale, because one of the fastest ways to scale can be through acquisitions of other companies. But I think a lot of people think, oh, I can't do that. I'm not big enough. But that's not necessarily true. I mean, there's lots of creative ways to go about that.
Yeah, and the people are scared of acquisitions is because they're scared of the unknown. They've never done it before. They don't know what they're getting into. But there are people who can help you with those things. But when you're looking for acquisitions, the first thing you should be looking for, how will this company integrate with mine, right? How is their culture similar to ours? And what kind of business model do they have? Do they have to go out and hunt, kill, and eat every day? Or do they have some kind of a recurring revenue business model set up? Those are some of the important things.
All right. So I got one more question for you. So in one of my businesses, we've got 50% of our business every month comes from repeat customers. Okay. Now, that's not recurring rev. Those are people who just love us and come back and buy. So how does that factor in? It's not recurring in the sense of somebody has subscribed, I have their card, and I can bill them every month, but they come back and buy regularly, to the point that every month, half my rev comes from customers from the past coming back and buying again and again. How does that get factored into a valuation?
So the analogy I give is there are country clubs, right? Many of the country clubs have a minimum of $500 a month or something. And the same people have to pay them $500 a month no matter what. That is pure recurring revenue. Yeah. And then you have what you're speaking of is kind of like a restaurant that's very popular with people, where people love going. Oh, it's my neighborhood Chinese place. I go there twice a week. That is also recurring revenue, but that is maybe a lower form of recurring revenue, where you have the same customers coming back, but there's no commitment. You don't have access to their card. You don't have a contract where you're not charging it again and again. As long as you don't screw it up, they will keep coming back. That is also great, but it's not as good as a real recurring revenue, where you have their card and you're going to charge them no matter what. Gotcha.
Okay. Now,
ideal recurring revenue is, think of it as rent. You got to pay it.
Yeah, exactly. And to that point, I think anybody who's been in the world of real estate and has tried to get financing from their bank on real estate knows that if you have a place that has a tenant in it, that you can show that they could move out tomorrow and be gone and the rent's gone, but they will look at that as additional income and factor that into, a mortgage, into lending. Same thing.
Yes.
All right. So, like I said, I love talking to you. I could keep talking to you about this, but we're running out of time. So, that said, if people want to learn more from you, I know you've set up a YouTube channel. You've got some great material there. Where can people find that?
Best way to reach to me is go to YouTube and look for What's It Worth, or just put in my name, Bharat Kanodia, and my name will pop up. And I have started this channel just to educate people on valuations. Nowadays, valuations has become such a household term. Anything that you watch, any movies that you watch nowadays, they're using the term valuation. And 15 years ago, people didn't even know what the hell it was. So I've taken it upon myself to educate the regular, everyday public and retail investors on valuations, and that's what I'm doing. And it's been a lot of fun.
Oh, that's amazing. We need more people like you educating the retail side. And honestly, I think it's going to be an interesting decade coming up with the massive influx of retail investors that have jumped into the market. But at the same time, I think in some cases, it's been made far too easy, where you now have people that have no idea what they're doing, sitting at home on their phone, nothing else to do, particularly young men who like to take risk, that have the Robinhood app and are throwing their freaking student loans on, to just let it ride, see where it goes. And do you think that's going to change? Do you think any regulation is going to come out of this?
No, the human tendency is to stay the same.
Yeah.
It doesn't matter. We'll just fall on our face and learn a lesson, but then down the road we'll make the same mistake again.
Well, of course, it's only human.
Yeah, I have a kid that I've hired. He makes $42,000 a year, and he lives in California. I'm thinking, how the hell do you survive in California with $42,000 a year? Oh. But the other day he's talking about, I've got this Robinhood app and this. I'm like, how do you have money to invest? But hey, he's making it work.
Good for him. So I have to counter that with, it sucks seeing these, people losing money because, frankly, that whole thing was just a transfer of wealth between people. Nobody really, some people made it, some people lost money, but people need to, where was I going with that? Lost it. Robert. Oh yeah. So the other side of it is I'm glad to see young people actually taking an interest in the markets and getting involved in it at that age, because, I was, I was in my 20s in the 90s, and there was very little in the way of, you still open the bloody newspaper and read the stocks there, right? There was no easy way to trade. It was really out of reach.
It was a cool thing to do, be sitting in the train and reading stocks.
Exactly. Yeah, that was it. That was it. All right. So, again, for everybody, that was youtube.com/what it's worth. Is that correct?
What's it worth?
What's it worth? All right. What's it worth? Don't listen to me there. And that said, I will include the link in the show notes, as I always do. So just let me say a huge thank you. I really enjoyed this conversation, and hopefully we can do it again sometime.
Good talking to you, Derek.
Fantastic. And now, guys, this is your opportunity to actually do something with what we talked about here today. And I would challenge you to go out and just start looking at some of these online marketplaces where there are businesses for sale, and look for ones that may be a fit for you, and start going through their sites, figuring out, what does that look like? What would it be worth to you? And start applying a little bit of what you learned here today. And I would really encourage you, if you have any interest in selling a business or buying a business, is to go check out the YouTube channel that was mentioned here. And I will include those links in the show notes. So again, now it's up to you. So that's a wrap for this episode. Go forth, take action, use these ideas, grow your business, improve your life, and I will see you in the next episode.
Thanks for listening to another info-packed episode of the Project Ignite podcast with Derek Gale.
Any links mentioned, along with an entire transcript of this episode, can be found at projectignite.com/podcast.
And to make sure you never miss another episode, go to iTunes or SoundCloud now and subscribe.